record. Okay, so we're starting with problem 1 of assignment 7, and we are given the U.S. economy operating below full employment. And the first thing we want to do is draw the graph, the long run aggregate supply, short run aggregate supply, aggregate demand graph showing the output in price level is Y sub 1 and PL sub 1, and the full employment output as Y sub F. So I bet you guys could I'm pretty sure you could do this without me helping you because you've done it before, but we're going to look at it anyway. So when you're operating below full employment, you're going to have you're going to have aggregate demand equal to short run aggregate supply, which I should have right here, I guess, below the long run aggregate supply, because this is where full employment is, the potential, right? This would be full employment, and you could also call this the natural rate. The natural rate of unemployment is right here at YF, this place right here. Okay, so this is what you would draw. You don't have to say, of course, you don't have to say SRAS 1, short run aggregate supply 1, because there's only going to be one. Now, I think somewhere in the problem I'm going to show you a shift, so that might be why I have this over here, but we'll get to that. Okay, so this is the initial graph that you want to draw. Okay. Now, the next question is, okay, we're going to assume that the Federal Reserve targets a new federal funds rate to reach full employment. And we want to know if they should target the federal funds or the interest rate to be higher or lower. And we haven't really gotten to this yet in our book, but it's not that hard. It's going to want they're going to want to target a lower federal funds rate, okay? And I'll explain why. So they're going to want to target one that's lower, because if they lower the interest rate, that's going to increase domestic investment, right? So if you think about buying a house, people are much more likely to want to go out and buy a new house if the interest rates are lower. And also remember that housing is considered not consumption, housing is considered investment, right? So the lower the interest rates are, the more likely folks are to go ahead and buy a new house or invest in general. So when we look at our actual function here for aggregate demand, if the Federal Fund, if the Federal Reserve lowers the federal funds rate or the interest rate, you're going to get an increase in investment, which is going to make the aggregate demand curve shift out to the right, hopefully up to the point where we're at a full employment. Okay, but the short answer is that the you'd want to lower a federal funds rate, because that would increase domestic investment. Now, why is that? Now, I'm going to get to this next graph next here, because it's asking us to draw it. Okay, so now that in part B, we've established that the federal funds rate is going to be lower. So how does the Federal Reserve make this happen? And we want to draw the graph of the money market to show what the Fed is going to do, what the Federal Reserve Bank is going to do to lower the nominal interest rate. So that looks like this. What they're going to do is they're going to increase the money supply. So this graph right here is the money market graph, and you've got the money supply, and the whole economy is a vertical supply, because it does not react at all to what the nominal interest rate is. The Federal Reserve does this, and you're going to learn a lot more about this in the next chapter, I think the chapter after next. But basically what they do is they buy bonds from banks, and so when they pay for the bonds, that puts money into the supply. So it's going to shift the money supply of the economy to the right, which is going to raise the quantity of money. And if you think about that, if the supply of anything goes up, the price is going to go down. And so the interest rate, the nominal interest rate over here, is the price of the money. So that's going to drive nominal interest rates down. Okay. And I think that answers it. Let's see. What are they actually asking us? Okay. Yeah. So what they're asking you to do, what they're asking you to do here is just draw this graph showing the nominal interest rate decreasing. Okay. All right. Now, the next thing is the next part of this is also something new, but once again, it's not that hard. Policy makers want to pursue a fiscal policy. Now, what that is either spending, government spending, or government taxing. Those are the two main categories of fiscal policy. Monetary policy is done by the Federal Reserve Bank, and that is either lowering or raising the money supply, okay? But if we're going to pursue fiscal policy, we're going to either tax or spend more, or tax less, or spend less, okay? So what they're asking us here is if they've figured out that the recessionary gap is $300 billion. So in other words, graphically, the difference between Y1 and YF is $300 billion, and they want to close it. Okay, they want to close that gap so the economy is operating at its potential. So, but we also know that the marginal propensity to consume is 0.8, which means that on average, consumers spend 80% of their income and are saving 20%. So that their marginal propensity to save would be 20%. Okay, if their marginal propensity to consume is 80%, because it's got to. But both of those need to add up to be 1 or 100%. Okay. So now we need to figure out what they need to do in terms of changing, in terms of spending more. Now here we're going to use what's called a multiplier, which says that 1 over 1 minus the marginal propensity to consume equals change in GDP over change in spending. So this is one of your multipliers. So we're going to use it right here, and we're going to put in the numbers because we were given that the marginal propensity to consume is 0.8. And we know that they want to change the output. They want to change the GDP by 300 billion. And what we're trying to find out is what we would have to, how much more would we have to spend, would the government have to spend right here in order to get this change, this increase in GDP of 300 billion. And we simply do the math, 1 over 0.2, because 1 minus 0.8 is 0.2. So 1 over 2/10 is 5. So 5 equals 300 divided by 60. So we know that in order to get an increase in a GDP of 300 billion, the government needs to spend 60 billion. Okay. Now, when you get to the chapter, it's either chapter 13 or 14. I can't remember which one. They'll explain a lot more about why this happens. But for now, just use the formula. Okay. It's right there. All right. The next thing that they're asking us is if the government changes taxes without changing government spending to eliminate the gap, Will the minimum required change in tax be greater, smaller, or equal to the minimum required change in government spending? Explain. Well, we figure that out by knowing what the tax multiplier is, which is marginal propensity to consume over the marginal propensity to save. So we simply put our formula here, and we're trying to figure out what we would have to change in the taxes in order to get that same $300 billion increase in GDP. And when we just plug in the numbers, 0.8 over 0.2 marginal propensity to consume over marginal propensity to save, we get 4 equals 300 over 75. So in order for the government to get the same increase in GDP, they would have to decrease taxes, have a tax cut of 75 billion, which is more than the 60 billion increase in a government spending. Why is that? Well, that's because that when the government spends money, all of the money goes into the economy. When taxes are cut, because 20% of the tax cut is going to be saved, the government actually has to cut more than the cut even more in order to get the same multiplier effect. Okay, because all of the tax cut, only 80% of the tax cut is going to be spent, because the marginal, because of up here, the marginal propensity to consume is only 0.8. Okay. Now the last part of it. Now, does anybody have any questions so far? Everybody good? Okay. The last part of this is a little bit tricky. Well, so it's saying, part E, assume the government lowers income tax rates to eliminate the recessionary gap. Will each of the following increase, decrease, or stay the same? So if they lower income taxes, the aggregate demand curve is going to shift to the right, because because people are going to have more disposable income, so they're going to consume more and they're going to invest more. So that's part of it's pretty easy. The aggregate demand curve shifts to the right, so aggregate demand is going to increase. Now, you would get full credit on this if you answered it any one of 3 ways, because all 3 could happen. Okay, it could stay the same. The long run aggregate supply is the potential of the economy to produce, and just changing consumption and investment may not change the productive capacity at all. So that would be correct. You would also be correct in saying that the long run aggregate supply could increase, because lowering taxes could lead to increased investment in physical capital, or as an incentive to bring more workers into the workforce. So that would be an answer. And you could also say, and it would be correct, that if the government had to borrow money in order to make up for the cut in the taxes, if the tax cut creates a budget deficit, the government's going to have to borrow money in order to function, and that could crowd out a private investment, and that could actually lower the potential GDP. So all 3 of those are correct, or any one of them is. Okay, because it's just really hard to tell exactly what would happen. Okay, and I believe that takes care of number 1. Does anybody have any questions about problem 1 before we move on? Okay, who else here? Who I got here? Okay, remind me. Hey, hi guys, the ones who came in. Hi everyone. Welcome back from the holidays. Before I go to problem 2, I just want to say I've graded everything in Blackboard. So the grade that you have in there as your final grade average is going to be your grade for first semester, okay? So you should know what it is. And all of you did really well, so that shouldn't be, so it's good. Okay, problem 2. Let's see, well, let me look at something. So it's going to be, okay, so this is also one where the U.S. economy is operating below full employment, and they've got a balanced budget, okay? So we want to draw the same kind of a correctly labeled graph, which is going to look pretty much the same as the other one. And I'll go over here for that. I'm going to come back to this in a minute. So it's going to look just like that one, just like the first one. So that's going to be easy enough, okay? Y1, YF, price level 1, long run, short run. Actually, I need to label this short run, which I need to, let me just grab this guy right here. Give me 1 second here. Let me copy. This should go right here, I guess. Okay. So now the U.S. government is going to increase spending. So we're going to get more government spending by $100 billion. And they're going to finance it by borrowing. So how will the pardon me, I've got a cold. So you just have to bear with me here. Okay. How will the increase in government spending affect each of the following? Cyclical unemployment, the natural rate of unemployment. Well, when the government spends more money, we know that shifts the aggregate demand curve to the right. So cyclical unemployment is going to go down, right? Because we're going to increase our output. So as we move from left to right on this curve, on this graph right here, employment goes up and unemployment, of course, goes down. So that we hope to get to full employment right here at YF, okay? Now, the natural rate of unemployment, as I said earlier, is full employment, is right here. And theoretically, that doesn't change at all because that's long run. That is determined by the potential in the long run aggregate supplies. And so cyclical unemployment goes up, and there is no change in the natural rate of unemployment, YF right here, or Y full, because the long run aggregate supply curve does not shift. Okay? Now, this is similar to the last one. It's saying the marginal propensity to consume is 0.75, which means that the consumers on average consume 75% of their income and save 25% of their disposable income after a tax income, okay? And we want to calculate the maximum possible change in real gross domestic product that could result from this 100 billion increase in government spending. So we simply use the same formula as before, but we don't know the change in output, but we know the change in spending. So our variable changes, but the formula or the equation does not, and we simply do the math and end up finding out that if government spending increased by 100 billion, the maximum change in GDP would be a $400 billion increase. Okay, just using this formula this a multiplier for spending. Okay. The next one, let's see. Okay, is asking us about a graph. All right, let's go back. Where are we? Okay, part D. Using a correctly labeled graph of the loanable funds market, show the effect of the $100 billion increase in government spending on the real interest rate. So this is the real interest rate. So don't get confused between the loanable funds market, which has the real interest rate right here on the vertical axis, and the money market graph, which has the nominal interest rate right here. Okay. The difference is this does not calculate in for inflation. Real interest rate does, right? So if the nominal interest rate is 5% and inflation is 2%, then the real interest rate would be 3%. Okay, right? So that's what the difference, one of the differences is. So don't get confused on that. But they're asking us, let me go back and see what they're asking us. Okay. Okay, right. So if the government spends $100 billion more dollars, the government's going to demand more money, or there's going to be less money in supply. So the demand for money is going to go up, and the supply for money is going to go down. So you could draw both or one or the other of these graphs and get full credit on this, right? I think it's or and, but the actual official answer says or, but I would argue that it's probably both are going to happen, right? But either way, the interest rate, the real interest rate is going to go up. That's what's going to happen. We know that no matter what, okay? So, because if we shifted this more, if we did two shifts on the same graph, I could find that guy. Let me just show you real quick. Jump back and go. This guy right here. If we copied him and just say we did two shifts on the same graph, you would end up here. So you would get even a higher interest. You would get even a higher interest rate, right? So the interest rate is gonna go up. That's what we know. Okay. Now, the question they're asking is, based on the real interest rate change, you just figured out, it's going to go up. It's going to increase. What is the effect on the long run economic growth rate? Explain. Okay, well, if the real interest rates go up, it's going to make a domestic investment more expensive because and this is why it's sort of confusing, but if nominal interest rates go down, people are more likely to buy a house. So that would have the opposite effect. But in this case right here, real interest rates mean if they go up, it means, well, the way you think about this is that companies typically borrow money in order to, actually, I just said that backwards. If either way, if the interest rates go up, there's going to be less folks buying houses and less investment overall, which means the economic growth rate would fall, right? Because it makes borrowing money, using your credit card, buying a house, investing, a company, a restaurant chain, opening up new restaurants, all that becomes more expensive because they typically borrow the money to do that. So that's going to make the rate of economic growth fall. That's the answer. Because a domestic investment in physical capital becomes more expensive. Now, I wanted to just pause here and just remind all of you guys, all of us, remind each other what economic growth looks like on a graph. You can either show it on this graph right here with the shift of the long run aggregate supply to the right. That's an increase in the rate of economic growth. What we're seeing in the question is a shift to the left. And you can also show it on a production possibilities frontier. The growth is shown by shifting the curve out. If the rate of growth falls, the curve is going to shift in. Okay. So you've got two ways. Let me just jump this out of the way real quick. So you can see, and I won't read that to you, but I'll just, have it there. You guys can look at it and review it. But that's just so you really have a good understanding graphically of how we show the rate of economic growth. Okay. All right. Wanted to review that. Okay. Where were we? Okay. Now, part F. Now assume that instead of financing the 100 billion increase in government spending by borrowing, the United States government increases taxes by 100 billion. With this equal increase in government spending and taxes, will the real gross domestic product increase, decrease, or remain the same? Okay, well, you guys can correct me if I'm wrong here, but I think this question is has an error in it, because they're saying up here, they're saying now assume that instead of financing the 100 billion, they're going to do both, right? It's in with this equal increase in spending and taxes. So they're actually doing both, aren't they? And the answer that the book gives you, or not the book, but the answer that they give you in the AP, on this exam is that they're doing both. So we're going to assume they're doing both, even though it says right up here instead. I think, am I misreading something, or is that sort of weird how that's worded? No opinion? Okay. I think it just doesn't make sense. It says instead, with this equal increase in government spending and taxes. Okay, well, anyway, the answer that we're going to, the way we're going to approach this is they're doing both, okay? So, first of all, we figure out using our formula that if the government are a multiplier right here, or spending a multiplier, and we know that the marginal propensity to consume is 0.75. It gives it in the problem right there. Okay, right here. So we know that. So we've already figured out, I think, way up here, that the change in GDP is going to be 400 billion. So I'm just reviewing that, just so we know where we are, right? So we've already figured this out. Right now, if they decrease taxes by 100 billion, we're going to use the tax multiplier, and this is going to be a negative 100 million, which means that when we do the math, it's going to lower. If we increase taxes by, let me jump back over here. It's saying if we increase taxes by 100 billion, that means that we're actually taking 100 billion out of the hands of consumers. So we look at that as a negative. And then that's going to give us a negative or a decrease in GDP of 300 billion, which means that, let me jump this out of the way here real quick. Oh, sorry. Let me just move this down. Okay. Which means that a $100 billion tax increase would not totally offset a $100 billion increase in spending. So if we gain 400 billion right here with the spending, and we lose 300 billion right here with the increased taxes, then we're going to end up with a gain, a net gain of 100 billion. So that because the tax multiplier is smaller than the spending multiplier, because consumers are saving 25% of their after-tax income. So that's your answer. Okay. So what they're asking, let me jump back over here to the actual question. Okay. So the answer would be that the gross domestic product goes up, increases by 100 billion. Let me just make sure I'm not thinking about that wrong. Yeah, that's right. Yeah. Okay. Does anybody have any questions on problem 2? Okay. Moving right along. All right. What time is it? 7:36. Good. So problem 3 is just very much like problem 1 and 2, except with a little bit of a twist. Okay. So problem 3. This time we're going to draw the same long run, short run aggregate supply, aggregate demand graph, but this time the U.S. is operating at full employment. Okay, full employment. So we're going to draw it like this, as you should already know. We're going to just draw it just like that. Okay, with the long run aggregate supply curve intersecting with the aggregate demand and the short run aggregate supply, which once again I don't have there. And I should. Let me just grab this guy again. Be right there. Okay. All right. So that's that. Pretty easy. Okay. Okay. Assume that the personal savings in the United States increase. Using a correctly labeled graph of the loanable funds market, show the impact of the increase in personal savings on the real interest rate. Okay, if people increase their savings, it's going to increase the supply of loanable funds in the market, because consumer savings in banks and credit unions is where those funds come from. So if there's more savings, there's going to be more loanable funds supplied. So the graph is going to look like this. Just with the real interest rate on the vertical axis, the loanable funds on the quantity of funds on the horizontal axis, and a rightward shift in the supply of loanable funds, which is going to mean the real interest rate goes down and the quantity of loanable funds in the market goes up. So, and what that means is, and this is going to answer the next one, I think. Let's see. Will interest-sensitive expenditures increase, decrease, or remain unchanged? Well, what will happen to the rate of economic growth? Well, if the real interest rate goes down, that means that people who buy things and have to borrow the money, like if you use your credit card to buy things, you're going to buy more because the interest rate is lower. people are going to be more likely to buy houses if the interest rates are lower. People are going to be more likely to make, or firms, companies are going to be more likely to make capital investments. So the investment is going to go up, and because there's going to be more capital investment in physical capital, the potential of the economy is going to increase. So we're going to get an increase in the rate of economic growth. And once again, graphically, you don't have to draw this for the question, but just so you know, just to remind you, the graph would look like this and this. This is showing an increase in the rate of economic growth, okay? All right, so we're that far so far, okay. Now we're going to look at a new graph, the foreign exchange market for the euro. So, because what we're being asked here is we're going to assume that the real interest rate of the Eurozone increases relative to the real interest rate of the US. Draw a correctly labeled graph of the foreign exchange market for the euro. Now remember, this is not for the dollar. We're drawing the graph for the euro, and show the impact of the change in the real interest rate in the Eurozone on each of the following: the demand for the euro and the value of the euro relative to the US dollar. Okay, so when we draw a graph for the euro, then the quantity down here is going to be in euros, right? So this is going to be euros. And the exchange rate is going to be dollar per euro. So whatever we're looking at, whatever currency we're actually graphing, the quantity of that currency is going to be on the horizontal axis, and that currency is going to be in the denominator in the vertical axis. And since we're comparing dollars to euros, then we put dollars in the numerator. So dollars per euro, okay? Now, let me just jump down here real quick, extend this. This is one that you guys missed a lot on the quiz, so that's why we're doing this again. So if the real interest rates in the Eurozone rise, this will attract foreign investors, because they can make more on their investments in the Eurozone if the interest rates are higher. Because what they're going to do, see, they're not borrowers. Foreign investors going into the Eurozone are theoretically, well, they're lenders, right? They're lending, they're flowing their capital, their money into the Eurozone, and they're buying something or investing. And if the interest rates are higher, they're going to get a higher return on their investment. So that's going to mean a capital flow into the Eurozone, okay? So the capital will flow into the Eurozone from the world, including the US. If the US current account, now the current account is the balance of trade, imports versus exports. That's the current account, right? And if that balance is zero, which I believe the problem said it was, right? Yeah, zero, okay? If that balance is zero, then we know that the financial capital account is also zero, because the two together have to be zero. So if capital is flowing from the US into the Eurozone, then that's going to create a financial capital account deficit in the US, because there's capital outflow from the US, capital inflow into the Eurozone, right? So there's going to be a financial capital account deficit in the US. And we also, and once again, if the capital financial account is in deficit, the current account has to be in surplus, because they both have to be balance out to be zero. Does anybody not understand that? That's important. Okay, I will take silence as a yes. Okay, so that's the tricky part. Okay, capital outflow from the U.S. is capital inflow into the Eurozone. So always be aware of the perspective, okay? This is graph right here is from the perspective of the Eurozone, because we're looking at the quantity of euros, right? So if the demand for euros goes up, right, goes up, then sorry about that. The value of the euro relative to the dollar goes up. So the euro gets stronger. So it's going to take more dollars to buy a euro, right? So more dollars per euro. That's why the dollar is in the numerator. Because if the value of the euro goes up, 1 euro costs more dollars now, right? So the euro gets stronger, the euro appreciates, and the dollar relative to the euro depreciates. Does that make sense, guys? Yeah? Say yes, yes. Shake. Good. Well, that's kind of it. I think that's it. Yeah. But just be don't get confused with these graphs. Make sure you know what's what here, because that can get very confusing if you're not careful. And I think that's it. All right, that's all of it. Yeah. So does anybody have any questions about anything? Oh, okay, great. I'm going to send out. Well, let me take attendance. Actually, how can I do this? I don't want to take up any more of your time, guys. Would you guys be okay with just sending me a really quick email saying that you attended? Would that be okay with everyone?
Yes.
Because I didn't get my graph ready, my spreadsheet, because I was in a hurry and I've got a lot going on here. Plus, I'm sick. So just send me an email, and I'll make sure you get the credit for attending. I'll be sending out a study guide for the quiz. What's today? Tuesday? By Friday, okay? And then the quiz is due the next Sunday, January 27th, okay? And this is the first assignment for a semester 2, for the spring semester. Okay. All right, guys. So thank you for coming to class.
Thank you.
Yeah, and I'll see you soon. Okay. All right, guys. All right. Bye.
Mr. Shelton, I joined kind of late. Sorry to let you know. I just want to make sure I'm here.
Yeah. Who is this? Who is this?
Yeah.
Hey, Lucia, how are you? Yeah, I just said since I didn't take attendance, just send me an email saying I was there. Okay, then I'll give you the credit. Okay.
Thank you.
Okay, thank you. Bye.
Bye.
Bye. Yeah.